Monetary policy. The definition of monetary policy refers to the process by which the government controls the supply of money in circulation and the supply of credit. The Federal Reserve Board increases or decreases the supply of money. Too much money or credit on the market, or if there's too much money or credit available for people to borrow in order to spend, inflation occurs. So when there's more cash available, you're going to spend it. When you spend money, prices go up. If there's too little money available, or credit is too expensive, or it's too expensive to borrow, the economy can stop growing. There are a couple of ways that the Federal Reserve will manipulate the supply of money on the market. They can control interest rates or the discount rate, which the Fed will raise or lower in the Fed will raise or lower the interest rates banks pay to the Federal Reserve for borrowing money out of their banks. They lower the interest rate, then borrowing money is cheaper. If borrowing money is cheaper, then banks will be more likely to lend it out. Oops, sorry, I didn't mean to go to the next slide. The Federal Reserve also controls the reserve requirements that banks are supposed to have in their bank at all time, and the Federal Reserve controls the buying and selling of government securities or bonds. Now I'm going to talk about each one of those things individually, but the key is that in order to create stable prices or keep there from being inflation and to keep people employed and the economy growing, the Federal Reserve will manipulate the money supply. The structure and organization of the Fed, you have a board of governors. Who serves on the board? Um, the governors serve 14 years. They have staggered terms to ensure stability and continuity over time, so you're not going to lose all of them at once. The chairman and the vice chairman of the board of governors are appointed to 4-year terms, and they may be reappointed and subject to term limitations. The responsibilities of the board of governors is to guide monetary policy. They analyze current international and domestic financial trends and conditions, and they lead committees that study current issues, and they try to make predictions about how trends and issues in the stock market are going to affect our economy. Okay, again, these are the people who set the reserve requirements or how much money a bank must hold on hand. And they operate without pressure because this is an independent regulatory agency that has public and private components. They operate without pressure from the president or Congress. Hold on one second. Now, outside of the Board of Governors, but still as part of the Federal Reserve, are your Federal Open Market Committees. These are councils whose members are drawn from each of the 12 reserve districts. You can see the map of the reserve district here. They meet 2 to 4 times a year, and they discuss the buying and selling of government securities or bonds in order to increase or decrease the amount of money in our system. They report on general business conditions also. So they come from each of the 12 different regional banks. So they each have some kind of perception of what the economy is like in their different region. And the slides are all out of order. Sorry, I'm trying to find the next slide. Okay, so let's talk about more specifically what the Fed does and how they manipulate the supply of money on the market. Okay, they set the discount rate or the interest rates. Okay. What happens if a bank doesn't have enough money to cover what the Federal Reserve is requiring them to have on hand? If they don't have as simplistic as it might sound, what if the Fed tells them they have to have a couple $1 million in their bank? If they don't have it, they have to borrow the money. The money or the rate that they have to pay is the discount rate. The discount rate is the interest rate the Fed charges its member banks when they borrow money to meet their reserves. Banks borrow money from the Fed, and the Fed makes money off of the transaction. Prime rates is the interest rate that banks then charge their customers. If the Fed charges the banks to borrow money at a high rate, then the banks will up their prime rate. The higher the discount rate that the Fed charges its member banks means that a member bank is going to charge their customers higher interest rates. If it costs more to borrow money, then people will not borrow money and they'll spend less. So if it's going to cost me a lot of interest, a lot of money in interest to borrow money to buy a car, then I might wait to buy a car. I might think twice. But if it doesn't cost me a lot of money to borrow, or if it doesn't cost me a lot to borrow money to buy a car, then I might go ahead and buy that car. The federal funds rate is the interest rate that member banks charge each other if they need to borrow money from each other for the short term. Again, raising the discount rate or raising the interest rate is going to decrease the supply of money. It's going to cool off the economy, and it's going to get people to stop spending money if we're having inflation. But if we need to stimulate spending and we need people to go out and buy cars and borrow money to buy houses, then we're going to lower the discount rate so we can get people spending money and stimulate the economy. Another tool that the Federal Reserve uses is open market operations. This is a fancy way of saying the buying and selling of government securities or bonds. You sell bonds to the people and to banks. The banks or people that buy the banks or the people that buy the bonds are saving their money. If you're saving money, you aren't spending it. When you're not spending money, you are cooling the economy off. So when the government wants you to stop spending and save money, they're going to make the buying of bonds or the people's desire to buy bonds more attractive. Now, if the government wants to buy bonds from the people and banks, then the government is going to encourage you to go spend your money. So, like if the government wants you to cash in your savings bond, or the Federal Reserve wants you to cash in your savings bonds, what they're trying to do, and this is as simplistic as possible. This isn't technically exactly beautifully how it works. But if the government wants people and banks to go spend money, they're going to buy bonds back from the people, so there's more money on the market. So instead of saving your money, you're doing the exact opposite. You have money to spend. The way that they manipulate whether or not you're going to buy or sell your bonds is by changing the interest rate available to those security or bonds. If the Fed raises interest rates on bonds, the Fed makes it more attractive for people to save their money because they will make more money in the long term from interest rates. Problems with monetary policy is too difficult to get a true calculation of the money supply. I mean, doing this in one day is really hard for me because like I can teach this over the course of an entire semester, but the money supply is very difficult to measure. So it's really hard to make these decisions on what to do with buying bonds. But it is important for you to understand that the decisions that the Federal Reserve makes impacts how easily we can get a car or buy a home, or how expensive it is for us to borrow money or save money. Okay. The reserve requirement. What is it? Okay, well, in this country, we have fractional reserve banking. Okay, fractional reserve banking is a system in which only a fraction of the deposits in a bank is kept by the bank on hand or in reserve. So that's a fancy way of saying when you deposit money into the bank, they only hold, say you deposit $1,000 into the bank is only going to hold 100 in their reserve, and then they're going to lend out the other 900 to a borrower. And then they're going to collect interest on the loan. That's how banks make money. Okay, so um, so what is it? The reserve or the fractional reserve banking or the reserve requirement is a system in which only a fraction of the deposits in a bank is actually kept in the bank. And I just gave you an example. Okay, currently most banks are required to keep 10% of their deposits as reserves with the Fed. So if we all use BB&T and we deposited $1 million at BB&T, that bank would have to reserve 100,000 of their deposits. Then they can lend out the rest of the money. The reserve requirement ratio is the regulation set by the Fed requiring the banks to keep a certain percentage of their deposits as cash in their vaults or as deposits in the region Fed Reserve Bank. Okay. The Fed also keeps banks money for the FDIC or the Federal Deposit Insurance Corporation. The FDIC, of course, is like if there is a huge depression, a run on the banks, or if your money is stolen from the bank, you are guaranteed your deposits up to $150,000. If the Federal Reserve wants you to borrow money from the bank, they're going to lower their reserve ratio and they're going to require a bank to hold less money in reserve. If they want to cool off the economy and keep people from spending, they're going to up the percentage of money that banks have to keep in reserve, which would prevent banks from borrowing or lending out a lot of money to the people. And remember, if people can borrow money cheaply and it's readily available, they're going to spend it. So let's look at it kind of in a more graphic form. So tight and loose money policy involves the changing and the cost and availability of credit. Loose money supply means that you want to make credit inexpensive and abundant, and you want people to spend money. So you want it to expand the economy. Now, it's a delicate balance because if you allow the economy to be expanded too much, then the problem is going to be inflation. If you have tight money supply, that means your monetary policy or the supply of money and credit is going to be less. You're going to make credit expensive and difficult to obtain. And again, you're going to do this to check inflation. The only problem with this is that you want to have a delicate balance and avoid economic contraction or too much cooling off of the economy, which can lead to things like unemployment because businesses, if people aren't spending money, businesses will lay people off. Okay, so in times of inflation, or what leads to inflation, money is easy to borrow, people will buy more, businesses grow, more people are employed, and if more people are employed, they have more money to spend, which causes a rise in prices. And then you want to check inflation with a tight or contractionary monetary policy. In a recession, or what could cause recession, is that it could be hard to borrow money, people will buy less, businesses will stop growing, unemployment will cause unemployment, and then production is reduced. And if you have a recession, then you're going to counter that with loose money supply.